The market has been all over the place. Your gas is more expensive, your groceries cost more, and if you have any money invested right now, it probably stressed you out at least once this year. I want to explain exactly what is happening, the actual economics of why your life is becoming more expensive, and why your portfolio has been more volatile. Hey, my name is Casey. I bring financial videos every single week. If you're interested in this content, feel free and subscribe so you don't miss another video. To understand where we are right now, we first have to understand how we got here and what happened in the first months of this year. Ending 2025 and going into 2026, there was a lot of optimism in the market. Right after starting the new year, a series of events changed everything. In early March, the US-Israel conflict escalated into a full war. Iran closed the Strait of Hormuz, and the price of oil rose significantly. Oil barrels went from being around $62 a barrel to over $120 per barrel. With all of this, the market significantly reacted. There were sharp moves up and down in the market with no clear direction. Shortly after, a ceasefire was announced. Because of this, the market bounced back slightly, but the underlying economic damage has been already done. In March, I watched my portfolio move 2 to 3% on a given day. If you felt that too, this is why. So why did one waterway wreck everything? Most people have never heard about the Strait of Hormuz, but what happened there explains almost everything that's going on with your money right now. The Strait of Hormuz is a narrow strip of water between Iran and Oman. Around 20% of the world's oil supply passes through it every day. When Iran closed it, that supply basically vanished overnight. Oil-producing countries in the Gulf ran out of storage. They had nowhere to put their oil that they were producing. The International Energy Agency described what happened as the largest supply disruption in the history of the global market. Oil basically surged from $62 to $120 a barrel. And this is not just some random number on a chart. Oil is the basic input cost for almost everything. It goes into manufacturing, shipping, farming, plastics, packaging, you name it. When the cost of oil doubles, the cost of producing everything also doubles with it. This is why gas prices are going up, why you might notice your DoorDash deliveries going up, the cost of flights will be changing, your groceries might be impacted as well. At the time of recording this video, a gallon of gas in the US hit an average of $4.12. That is 38% up since the start of the war. Before the oil prices shot up, the economy was showing some warning signs already. That GDP growth fell from 4.4% in one quarter to just 0.7% the next. The GDP has begun to slow down, and the job market is also being impacted. The most recent job report showed that the US lost 92,000 jobs last quarter. At the same time, US manufacturing has been contracting for the last 9 months. And to add on top of that, the inflation rate is also above the Fed's 2% target rate, meaning prices were rising faster than what the Fed wanted. And then most importantly, consumer confidence is at an all-time low. Americans are not feeling confident. Think of it like this. The economy was showing warning signs already, and then the oil situation just made it worse on top. So the real question is, are we headed into a recession? Here's what the data says. There's certain institutions where their sole purpose is to model the recession probabilities. Moody's Analytics has a recession model that's been trained on 80 years of economic data from the US. It's called every single US recession in that period without a false alarm. That's 1 point away from 50%. And once this model hits 50%, a recession has been predicted every time. Goldman Sachs is predicting a 30% recession probability, and they've revised this about 3 times this year. But even while the recession indicator is at 49%, that means 51% of the indicator is pointing to no recession at all. Even with everything that Goldman is saying, they still keep a positive outlook on corporate earnings. I'm not here to tell you that a recession is coming. No one really knows that. But I wanted to tell you that the people who are actually measuring these things and their job is to look out for a recession are concerned about it. And they're concerned now more than they were when there was a global pandemic in 2020. Okay, so that's what's happening now, but what does it mean for you and me and people in their 20s who are looking to build wealth? Even with a ceasefire, it's going to take months for things to recover, oil supply to rise, and infrastructures to get rebuilt. The best thing you should do right now is to make sure that you have a fully stocked emergency fund with at least 3 to 6 months of expenses. Now, what does this mean for your portfolio? Volatility does not mean stop investing. And it also doesn't mean you're going to have a permanent loss. Just here's a fun fact. Since 1950, the US has experienced 11 recessions, and every single time it's recovered and hit new all-time highs. If you're investing every single month into index funds, don't stop. The people who came out the strongest after each recession were not the people that predicted it. It was the people that kept investing through the lower prices and caught the recovery on the way up. Volatility might seem bad because you see your portfolio fluctuating very often, but for somebody in their 20s looking to build their wealth, you should see it as an opportunity. Essentially, you're having the opportunity to buy assets at a discount relative to what they were 6 months ago. Your job is not to predict what's going to happen next. Your job is to focus on building a sound foundation so we can handle anything that comes its way. The news makes everything feel like a crisis, and the data risks are real, but they're not certain. I've been watching this unfold at the same time as you. My gas is more expensive, my groceries are more expensive, but the thing that you have to remember is the people that can push through this and invest as the market is going down are the people that are going to come out of this most successful. Use the volatility to your advantage to build a greater wealth. Stay the course and continue investing. Those that handle the moments of volatility the best and stay the course are the ones that come out ahead once everything recovers. If you want to see this stuff every week, what is happening to the economy, what it means for Gen Z, and what to do about it, then subscribe. Let me know in the comments if you think that a recession is coming this year. I want to see what you think. Thank you for joining me today on another investigative look into your wallet's future. My name is Casey. I'll see you in the next one.